Hi, this is John Parisi, and in today's video we're going to talk about maximizing your credit score. Our team can't stress enough how important this one simple issue that most people take for granted is in the wealth creation process. A lot of people have the goal in building their net worth of just maximizing some big portfolio. It's a lot more than that, because when recessions hit and markets contract, well, there's all your wealth going down with the market until it makes its comeback. Instead, you need to focus on developing a fortress-like balance sheet. And the fortress-like balance sheet is designed to basically bridge the gap between good financial times to when they return from bad financial times above, and bridging that gap. And the cornerstone of that is having a cash reserve, which we'll talk about in another video, and the importance of that, but also access to credit and liquidity, as that's how you're going to survive that trough. So you're going to want a strong credit score. In the old days, they used to measure your credit worthiness based on your tax returns and a couple of months' pay stubs. And they'll say, okay, this person makes a lot of money, we can give them this size loan. The reason that became ineffective is because when they give you a loan based on your income, well, maybe you're not responsible. If you make a ton of money, but you spend a ton plus two, you're not a good credit. So they devised a system that demonstrates this important sentence, and this is what we want you to remember. Your high credit score, or your credit score in general, is based on your ability to manage credit over time, okay? And what that means is they're going to hand you credit, and they want to make sure you show fiscal restraint. You don't tap it all the way to the top every month. You pay on time, maybe you pay a little bit early, and that you're just showing financial restraint. Think of a candy bowl. If they put a candy bowl in front of you and you know it's not good for you, but it's so delicious, do you eat to the bottom of the bowl, or do you just take a few pieces and move on? Think of your credit cards as the same way, and that's how you're going to get a good credit score. So let's go through these bullet points that we've put in our write-up that is on the website. Number one, view your credit cards as a tool, not a loan. So you should be just charging what you know you could pay off every month from your income or savings, and don't view them as a loan. You get a better loan from a bank directly for a small purpose loan. Otherwise, a credit card is going to change 18 to 28% these days. So the number one step to getting a high credit score is you only want to use 30% of your credit limit per month. If your limit is $10,000, don't take out more than $3,000. If you need to spend more than $3,000 to meet your lifestyle, get a second card with, again, for the example, $10,000 limit. You use $3,000 on this card, $3,000 on the second card, and pay that off on the due date or 2 days before the due date each month, automatically in full. Those two things, paying 2 days before the due date and only taking 30% of your available limit, shows incredible financial discipline. And you might see the banks very quickly come and want to give you more credit because you've demonstrated that. I wouldn't say you take it, okay? You want to keep this balance. Remember, credit cards are a tool, not for spending money. Again, you want to pay on the due date after the billing cycle ends, about 2 or 3 days before, and set up automatic reminders or automatic payment systems on your bank account that make sure you don't miss this. Number three, do not pay your card off mid-month. You want to get the 30% or lower to the end of the billing cycle. If you pay it all off before the billing cycle ends, you're going to show that you didn't use the card. It'll have a zero balance at month end, and you won't get a boost to your credit score. It'll just think you're not using the credit card. So you want to go to your 30% limit, but don't pay mid-month. And the only reason to pay mid-month was that you exceeded your 30% threshold. So if you have $3,000 that you want to use on your card, but you spend $3,500, you want to pay that $500 before the billing cycle ends. Your card age is very important. Okay, one of the thing that they look at is how long have you been able to manage credit over time. So if you have a card for 3 months, you won't get much credit. But if you have this card for, say, 10 or 15 years, you're going to get a big boost in your score for that. So don't cancel old cards. Even if you're not using them, always keep your oldest card. And you can keep it alive by charging $50, $75 a month on it, but use your cards you prefer that are newer maybe for your 30% threshold. And the last thing is, you got to watch your credit card inquiries. This is where people quickly drop in credit score because they're always applying for new loans, or when you get a cell phone, they could pull your credit. When you get a new utility to use at your home or your new home or your apartment, they're going to pull your credit. Every time you apply for a credit card or a car loan or a tuition loan, they're going to pull your credit. And inquiries take 2 years to drop off. It only represents about 5% of your credit score, but it's an easy way for these to gap up. If you've had 6 credit pulls in a year, you get dinged pretty hard. But getting a credit pull is a fact of just basically living in this financial system. So you get a car loan and you apply for a credit card. Those should be your only 2 of the year. and then they'll drop off. So those are the main bullet points on here. If you have any questions, again, refer to the piece we put on the website, or simply contact anyone on the team and be able to talk to you about it more. Thank you so much.